you have a number of cracks in the system, in the US system, which from an investor perspective, we think means we've reached that point where we need to look elsewhere. We've all had a lot of US assets for 10 years. It was fantastic to hold the S&P, to hold even US bonds. The dollar was fantastic. But all that is deeply changing with this profound change of world we are facing now. So let's review these cracks. First, for an investor, what matters was his return. What do you expect in terms of return? We could say a lot on that. Just in a few words, we've seen last year, for the first time in more than 50 years, a drop in performance from US equities and bonds. So the worst year in a long, long time for US investors and foreigners that were invested there, even if foreigners were helped by a strong dollar. But for locals, it's been very painful. Now, what can we expect from there? Is it just a one-off, or is there more to see? There's probably a lot more to see. This is, on the left here, the outperformance of US equities relative to the rest of the world. So, equities. You see, and that's a long chart, that's 75 years. We could have even get back before that. We've never seen that. Basically, US equities have outperformed other equities big time. Now, some of that is due to extra profits. So you would argue that makes sense. They are delivering superior profits, and particularly the big ones, the so-called FANGs. But not just. There's also a re-rating phenomenon. On the right, this chart shows valuation. Valuation of US equities got richer by about 30% relative to the rest of the world. So it's not just extra profits. 30% mean basically half of what you see on the left is just re-rating from investors saying, wow, I'm doing so much better on the US equities, I'm going to buy more. I make them richer, prices go up, valuation-wise. So there's, if you are to normalize this, because the conditions are now back to higher rates, more inflation, which should make the US market converge back to others valuation-wise, you're already halfway on the left. Now, on top of all this, higher rates will make the life of these US companies a lot harder. Superior profits, essentially, for a big part of it, where it's really supported by lower rates and larger liquidity in the US. Now, you just reverse that, it's going to be very tough for many of these companies to maintain margins, the superior margins they've had so far. And they have already started to compress these margins in the US. And that's, there again, that's just the beginning of the process. So it's not just a re-rating or a de-rating exercise. There will be, on top of that, pressure on margins. And that tells us what you see on the left is likely, over the years, to normalize even more than the 30% you see on the right, and get back to that normal regime we've had for 75, if not 100 years, relative to the rest of the world. Now, that's return. And of course, do you really change your asset allocation just because your return is a bit lower? Not necessarily. You've got to look at the risk side of things as well. Now, there again, 2022 was about seeing less returns or negative returns on US assets. 2023 might just be the year where you realize there's also more risk in the US system. Let's, again, there again, just a few indicators, a few elements to sort of touch really what that means. On the left, you've got the volatility, relative volatility of European equities versus US equities. European equities were more volatile than US equities, and particularly that's a smaller index with 50 stocks only. So 7 points of volatility more, that means 30% more volatile in Europe. And that was back 7 years ago. Now, Europe is now less volatile than the US market, in spite of, again, having much fewer stocks in the basket. That shows that from a market perspective, markets have adapted to that notion of riskier US stocks in general. When you are overvalued or richer, of course, your profits tend to move more, and that fuels volatility. So that's an illustration of how the world has changed to that respect. and how that should continue to be the case in the coming years. Now, you could also qualitatively list a number of risks. We've seen a few earlier with the banking sector. You could mention on the macro side that you have tighter financial conditions in the US than in other countries. It's more advanced in the cycle. You got more leverage there. You got less excess savings. You could argue that the currency is also on the strong side. The dollar is substantially overvalued. So you have a number of macro risks, and on the macro side, we've seen the regional bank mismanagement issue. It's a local problem, so we can see that as a systemic risk. But for investors, that is something, of course, with your allocation. If you are exposed to that innovation sector in the US, you cannot really expect much upside there, even with the recent derating of the sector, because there's just too much to adjust there. So you have a fairly long list of risks you have in the US that you don't have in the rest of the world. So that return risk getting a bit more questionable means investors now have started to look for alternatives. Now, of course, there's also the long term, which has implication on an important asset in the US. We mentioned equities. We mentioned bonds, but what about the dollar? The dollar also is at risk. It did quite well last year. It's been struggling a bit more since, and for good reasons. Very fundamentally, I want to keep it really there, simple. The US is running large twin deficits. It's not the only country, but it's one of these countries where these twin deficits are pretty big. So that's trade and government spending taken together. Now, that means every year the US needs more money from the outside world to keep that economy, its economy afloat and its currency afloat. You're talking there, cumulative basis of 8-9% GDP. That's going to improve a bit, but not by much in the coming years. Now, put that together with the debt projections. That tells investors, well, am I really keen to buy treasuries and finance this economy that needs more money every year when I see that on the right? Wow, that's maybe I'm going to ask for some depreciation of the currency there. As a foreign investor, that's what I would do in any other country. That's what investors did in the UK last year, for example, with the sterling collapsing. For these two reasons, no more. Now, from a US perspective as well, as we reviewed with your question, Babak, that means, on the US side, what's the path of least resistance? What's economically the easiest way to adjust all this, the whole system? A weaker currency is by far the socially best solution. So in the shoes of the administration out there, they're more likely to go that way than tighten conditions, cut the budgets, cut spendings, and so on. So the dollar is really at risk of a more structural depreciation. So not just the tactical moves we've seen lately, something more structural, because that's the way out for the US in this whole system. So it's not just bonds and equities, it's also the currency itself.